Hi everyone, this is Aness, and in this video we are going to cover the market risk. So the first question is, what is the market? The market is basically all the stocks out there. It's everything. It's the market. It's all the companies that exist. But in practice, what we really call the market is the large cap. It's the biggest companies, and the real index we track is the SP 500. So you have the Dow Jones. It's the 500 biggest companies. You take them all and you calculate the average yield, and that's the Dow Jones. And this index, we track it because it's the oldest one, so it's been here forever. But recently we started tracking, so since 1957, we started tracking the S&P 500. The difference between the Dow and the S&P is how they weight the constituents. In the S&P 500, it's weighted by market cap. So the big companies like Apple, Microsoft, Nvidia, this is old, Nvidia now is 7% as well, have the biggest weight and they drive the market. So if you buy Apple, Microsoft, Nvidia, the three together, you already have 20% of the S&P. Okay? So let's move on. Now the market risk. So all the stocks, they correlate with the market. If there is a crisis, everything will go down. Okay? So the best picks will go down regardless. And how can you model your stocks? You can model your stock by saying it's the alpha. The alpha is the value that we bring, the smart value, times the beta, plus beta times the market. So each stock has a certain correlation with the market. A stock that has a positive beta will go up when the market goes up. A stock that has a negative beta will go down when the market goes up. Now, you can see it here. When the market dips in green, some stocks will dip a lot. These ones have very high beta, and some will barely move. These ones have low beta. Beta tells you how much your stock moves when the market moves by 1%. And you can find it in the app. And it tells you also the risks of your stock with respect to the market, because there are other risks to consider. We'll see them after. And so where to find it in the app? You go in the metrics tab. Okay. Then you select stocks, beta, and you will sort them by beta. You can also search and filter to see exactly what's the beta of your stock. But Nvidia, for instance, is a stock with high beta. So when the market moves by 2%, if Nvidia moves by 4%, nothing happened. Nothing happened. Don't tell me Nvidia moved by 4%. The market moved by 2%. It's your beta. If the market moved by 1% and Nvidia moved by 10%, okay, something happened. Stocks with low beta are stocks like Coca-Cola. Coca-Cola is not going to move a lot. When the market moves by 1%, Coca-Cola moves by 0.5. If the market moves by 1% and Coca-Cola moved by 2%, something happened. If the market moved by 1% and Nvidia moved by 2%, nothing happened. Okay? So the beta means something. Now I'm just going to show you something very cool. So in these graphs, you actually have a sort of data cube. You have a way of visualizing things with 3 dimensions. Okay? So here you have your beta. Sure, you could select any other metric, but you can also visualize any other metric over time against your beta. So here I'm selecting revenues, but it could be something else. And you can also visualize the stock price over time for any given time period. So you can do very quick analysis by sorting stocks, checking how the price moved over time, and picking some metrics, like it could be revenues, it could be short interest, it could be ownership, retail ownership, etc., and see how it works. Anyways, and you can also do it by using the same metric against each other. So the short ratio, you could sort by short interest, and then use the same metrics to visualize it over time and see how the price moved. When the shorts go up, something that's very shorted, obviously you expect the price to go down. Someone is shorting it, they're overselling it. Now what happens here, if the financials go well, so you could start for revenues by revenues to see what revenues look like, it means it could get short squeezed and you could have the stock spike up. Anyways, some details. So we talked about the market risk. Now the question is, how are you going to predict your market risk? This is what matters, right, Aness? Thank you. You're telling me how things. I don't know how to predict. I don't care about the risk. I want to know what's happening. So you go in the signals tab. I'm going to do it very briefly here. It's not going to be a 1 hour analysis, but basically you go in the signals tab. You can check the market calendar yield. Okay, this calendar yield, it gives you the average of how the market moves every day over the past 50 years, how it did. Okay, so it's the average. Statistics are again 80%. Okay, you know nothing. Okay, like Jon Snow. And so you could see things like, look, September, it always dips after summer. After summer, it's always dips. People come back from vacation, they are tired, summer is over, kids go back to school, you have to spend money, you need cash. Plus you see the market dip, so like it all happens together. And early January, end of December, here you don't see, but there is more to it, to the screen. The market always recovers. Why? Because people are happy, they are cheerful, they have time off, they want to invest, they see it go up, there is low liquidity. So naturally, as soon as people buy, it goes up very fast. The market makers are on vacation. And so, yeah, you can check this in the app. It shows you trends, okay? Here you do it for yields, but you can also do it for events. But before we go to events, let's check what events can move the market. If you check the onboarding in the app, and please have a look at onboarding because it has a lot of great information, you can see that some macro and economic events will affect your market, okay, the market. And these are things like CPI, PPI, etc. These affect all the stocks. So they are all going to move together. And you can also try it based on these, but again, please understand what's happening first, and then we can see. CPI is something very important. It's an index that measures inflation. So basically, they group a lot of prices coming from all groceries and things like the price of burgers or whatever, and they see how it moves over time. And based on how the average price moves over time of the same goods, you know how is inflation moving, because basically inflation is just how much the price is moving over time. And you can even see where it comes from. You can see if it comes from groceries, from rent, from oil prices, etc. And so this is very important. And I have so much I want to talk about, but I'm going to try to follow the slides. And so something else is the Fed meeting, okay? So the Fed, the role is to set interest rate policies, to talk about and give guidance about economic outlook, and to set monetary policy, all right? People are looking for rate cuts. So every time you hear about the Fed, you're going to hear, is there a rate cut coming or not? What's happening? Why? Because rate cuts are, if inflation is controlled, rate cuts are good for the economy, okay? Why? Because when you cut rates, you basically make it easier and cheaper to borrow money. So for businesses, it's great, okay? Like business borrows money for free, you get cash as much as you want, you have less debt to pay, it's great. For big tech, it's amazing because big tech, they have recurring revenues. Recurring revenues, they pay over 10, 20 years. So like, and the value today of the big tech is how much these 20 years of revenues coming are worth today. This is the value today. When you cut rates, you lower interest rate. So $1 today will be worth less in 10, 20 years. Okay, because rates are lower. If you invest it at a lower rate, it will be worth less. And the same amount then will be worth more today when you cut rates. But if you increase rates, the same amount will be worth less, because all of a sudden, with the new rate, you could have more. You could have more. You see? So when you lower rates, you say this amount is worth more. Why? Because with the old rate, it was worth less than what it would have been. Anyways, so when you cut rates, the big tech, their future payments, because big tech is valued over 20 years, big tech, it's recurring payments. They pay a lot over time. They get paid a lot over time. All their future payments are going to be worth a lot more today. So when you cut rates, big tech, boom, goes up, okay? So this is how it correlates. Now, how to watch this event? So there is the, I'm not sure how we say in English, FOMC, anyways. There is the meeting that happens every month and a half, where Jerome Powell speaks live, and you can see him on YouTube, okay? If you pay attention to his statement, you can read the language carefully, you can read his tone, say what he's saying, you can try to predict live what's going to happen, okay? But this is like short-term trading. Key phrases like higher for longer, it means no rate cut coming, it means, okay, it's not going to go up now, huh? So like people are going to sell. But again, you have to watch it, and you have to be alert, and don't start trading right, just watch, and I'm going to show you some patterns. But this, you can see it live on YouTube, okay? Now, in case of a sell-off, prices usually bounce back. Why? Because this often happens during the day, people are a bit sleeping, and all the traders, they want to trade together because everyone is watching the event. So like everyone hits the buy or sell button at the same time, and things move fast. Usually it's a short-term opportunity, but long-term, it depends on what is being said. And if you look at the previous meetings, where Jerome was the chairman, you can see that usually, as soon as he starts speaking, so this is like statistics and you have to compare. So the blue graph is the past 10 Fed days, and the red is all the Powell Fed days in the past. And you can see that recently there has been much more volatility than before, okay? Since Trump, since even before, I mean recently, usually how does it go? He starts speaking, boom, it goes a bit down, then goes up, and then goes down. This is like intraday, you know, and I would not recommend you, I discourage you from doing it, from trading intraday. But what's good to know, and you can check it in the app if you go into events, is you have to know what's coming and when, what's happening when, etc. When is the next Fed meeting? When is CPI released? When is PPI, etc. NFP, non-farm payrolls, and usually before the event, markets dip, okay, because there are uncertainties. So markets dip before and then they recover after. It's often like this. Obviously, it depends on what's being said, you know, like it depends on is CPI showing lower inflation or not? Is PPI showing lower inflation or not? Is what does Jerome Powell says, etc. And so, okay, so in this video we covered a lot. We covered the market risk, and thanks for watching. Speak soon.